VA loans versus conventional loans. We're going to battle it out in this video and go through some examples with the minimum down payments, 5 and 10% down payments to see which loan option is better for veterans. So before we kind of get into some of the numbers, and we'll do that here in a moment, there's a few things we want to do when comparing VA to conventional, and that's just start with the down payment. With VA, the minimum down payment is zero. You can purchase a property and potentially, if you have enough entitlement, put down nothing on the home. Whereas conventional financing, the minimum down payment is going to be 3% if you are a first-time home buyer. Right out of the gate, VA takes the lead just because of the minimum down payment being zero compared to conventional financing. The next thing we want to do is compare the interest rates, and we'll see that here in a moment when we look at these financing examples that we've prepared. But typically, VA is going to have a more attractive interest rate, a better interest rate than conventional financing, saving the veteran thousands of dollars over the life of the loan. Again, another win for VA. The next thing is the private mortgage insurance. VA does not have any private mortgage insurance, whereas conventional has PMI. Now, the truth is VA has something called a funding fee, and I'll share that funding fee here on the screen over here somewhere. And it depends on your down payment, and it depends if you are exempt or not from paying that funding fee. But assuming you are not exempt, you will be paying this funding fee based on your down payment percentage. A first-time user, it's 2.15. A second-time user, it is 3.3 when putting down less than 5%. But that funding fee significantly drops when you start putting down 5 to 10%. We'll go through these examples here in a moment. But conventional mortgage insurance has private mortgage insurance, whereas VA has none. The next thing is the eligibility requirements. In order to use VA financing, you have to be eligible for it. You have to be a veteran that has entitlement, or active duty service members that meets the requirements, National Guard and reserves. So you have to be eligible to use VA financing, whereas conventional financing, anybody can use it anywhere in the country. Again, we'll take that for a win for conventional financing. The last thing is the loan limits and the entitlement. With VA, there really is no loan limits. It really just depends on the lender's overlay. Some lenders cap the amount of 100% financing on VA to a certain amount. In most cases, I've seen it anywhere between $2 million to $2.5 million, meaning that the veteran can purchase a home for $2 million or $2.5 and put nothing down. Now, it's really up to that veteran's entitlement, how much of a down payment could be required. But with conventional financing, there are loan limits based on where you are buying. There's a regular balance conventional loan, and then if you are in a high cost market, you could potentially do what's called a high cost or high balance conventional loan. So without further ado, let's go ahead and just start looking at these comparisons. We're going to start off by looking at the interest rate, and I have gone and just used the Mortgage News Daily's average interest rates today when comparing these loans as well. There are many factors that can impact your interest rate with conventional financing, but for right now, let's just use the average of 6.64%, whereas VA, the average interest rate today is at 6.1%. If you are curious and you want to see this for yourself, I'll link this website in the description of the video, along with each of these loan comparisons that we're going to go through here in a moment. They will all be linked in the description. You can click through them on your own. And if you want us to customize this to match your specific needs based on your credit score, your debt to income ratio, let us know and we can easily do that for you. But before we do that, my name is Tim Kelly. I'm a loan officer right outside of Washington, D.C. The purpose of this channel is to help you manage your mortgage and finance your real estate goals. So if you are new here, go ahead and subscribe and hit the notification bell because we have videos coming out like this all the time and you don't want to miss any. But this is a loan comparison tool. This is something that we use when comparing different loan products, down payment percentages, whatever our clients need. We want to make sure that they understand why this product may be better suited for their financial situation than another. In this case, we're just looking at VA versus conventional. And this scenario that we have up on the screen now is with the minimum down payment. So that is a VA with a 0% down, comparing it to a conventional loan with 3% down. You can do that if you are a first-time home buyer with conventional financing. All of these scenarios assume the same property being purchased. That's a $500,000 property here in Northern Virginia. So we're using our closing costs and our taxes and our homeowner's insurance costs. Right out of the gate, it tells you what has the lowest payment, the lowest cash to close, and the lowest cost over a certain period of time. You can see here VA takes the win in both the lowest payment. We'll see that breakdown here in a moment, and the lowest cash to close. No brainer there. when you're comparing 0 to 3% down. You can tab through each of those to see the breakdown and see it'll highlight which option is the best. But if we're looking at your conventional versus your FHA, you can see here the lowest monthly payment is going to be the VA, mainly because of that interest rate going from 6.64% down to 6.1, even though VA has a higher loan amount in this case. Again, this is 100% financing, and you're taking that funding fee, 2.15%, and you're rolling it into the loan. You have the ability to pay it at closing if you want to, but most veterans, in my experience, will finance it, meaning that you're starting off with a loan at over $510,000, but even at the 6.1% interest rate, it is a lower monthly payment compared to conventional. You can click and see the breakdown of what's going towards principal versus interest in the beginning of the loan. And then you can look at the total breakdown of the monthly payment. This is, again, a difference due to the private mortgage insurance. We're assuming, based on someone having a great credit, the mortgage insurance with 3% down, in this case, is $234 per month. They're not able to take advantage of some discounts that may be eligible. They might be eligible for with conventional financing. Again, just trying to make it apples to apples comparison. So we're showing the mortgage insurance cost to be $234. VA has no private mortgage insurance, so that is also reducing their monthly payment. So you can see here the monthly payment, the difference is, from just under $4,000 a month to under $3,750 a month. Your cash to close, again, no surprise here. There's no down payment with VA, so it's going to be less. You have $14,710 with VA using 100% financing, comparing that to conventional because of that 3% down payment. You're just under $30,000, and this assumes the closing costs here in Northern Virginia, which are going to bring them right over $9,000 for this price point. And then you have prepaids and escrows. You have to establish an escrow account. Taxes and insurance are required to be escrow for both of these scenarios. VA is required no matter what. With conventional financing, if you put down less than 10%, you have to escrow your taxes and your insurance. Looking at the lowest cost snapshot over a period of time, you can see that which option is the lowest cost. And then the estimated appreciation, this is based in Burke, Virginia, my hometown. Shout out Burke, 22105. And assuming with forecast appreciation, 10 years down the road, you will have seen almost $270,000 in appreciation in Burke, Virginia, using the forecast we have. An equity snapshot, you can tab through this and look at it over time and see which option comes out to be the best given the likelihood of you living or having the mortgage for that long. You can also click over on the loan details and see a breakdown here. Again, look at that difference in the monthly payment. VA does not have any private mortgage insurance, and with the lower interest rate, you're seeing a big difference there in the monthly payment. Again, saving the veteran thousands of dollars. It has a breakdown here. You can see that the funding fee for VA right here, that $10,750, that is not being collected at closing, and also there's no down payment. But that is your minimum down payment comparison. Let's take a look at what happens when you put down 5%. With 5%, the funding fee for VA is going to drop, and that's going to even build the case more for the veteran wanting to use VA financing because it still has the lowest monthly payment and it still has the lowest cash to close. Again, same scenario. You can see the difference here in the monthly payment. You're putting down 5%, so you have a lower loan amount, so you're saving there on the principal and interest. The mortgage insurance with conventional financing starts to improve because you're less likely to default in the eyes of the mortgage insurance companies, going from 3 to 5%. But everything else remains the same. Your cash to close is starting to equal out here because in both scenarios, we're showing you putting down 5%. If we click over on the loan detail now, you can see the difference in the monthly payment. Again, there's no private mortgage insurance. That's really where you're seeing the big difference on top of the interest rate. And then we can see that funding fee, when you put down 5%, goes from $10,750 to just over $7,000. We're financing this funding fee, rolling it into the loan again with the 5% down option. But just like before, it looks like VA is going to win this with 5% down. Let's take a look at 10% down. Same property, $500,000, same taxes, same insurance, but instead of putting down 5%, you're now putting down 10. You can see still VA has the lowest monthly payment. VA has the lowest cash to close, and you can tab through those to see the breakdown. The monthly payment obviously is lower, again, because you are borrowing less in this scenario. If we take a look at the appreciation, that doesn't change because the home is going to appreciate no matter what product you use, which is often what I say, doesn't really matter what loan option you use. Buying a home usually makes sense over renting if you can afford it and you're comfortable with the payments, because you do lose some of the flexibility when you own a house and you have to maintain that home. So it's important that you're comfortable with these. But no matter what option, you're seeing that appreciation as long as you're maintaining the property. But a big difference in the funding fee when you put down 10% versus using 100% financing with VA financing. It goes from $10,750 to about half, $5,625. Again, we're rolling that into the loan in this scenario. And because of that low interest rate and the fact that there's no private mortgage insurance, the monthly payment is lower. And again, the cash to close is a little bit lower because of the per diem interest that's being collected. But these are all linked in the analysis that each of these loan comparisons is linked in the description of the video. So if you want to click through them on your own to see the big difference, go ahead. If you want us to customize it, like I said earlier, just shoot us a message, send us an email, and we can turn around those loan comparison tools for you. Not just comparing conventional to VA, but any other products that you might be considering, like conventional versus FHA. We can do that as well. Thanks for watching, and if you found this video helpful, check out some of these other videos. You might find them helpful, so check them out. Please.